In today's day and age, with inflation running hot, government spending going up, you have to invest and own real assets to simply keep up. If you don't invest or own real assets, you're simply going to be left behind. That's the sad truth. With that said, I've actually started selling my tech and riskier growth stocks and holding cash, no longer buying equities. And I'll tell you why. But first, I'm not a financial advisor. Never blindly trust a guy on the internet. This video is for entertainment and informational purposes only, and please do your own research. Let's be honest, we're in an AI tech bubble. We've all seen the same circular flow chart, the same handful of AI companies buying and funding each other, inflating valuations higher and higher. The Shiller PE ratio is flashing red, one of the highest times in history. The Buffett indicator, which compares the total stock market to US GDP, also shows extreme overvaluation. Sure, it's a little outdated because it only shows US GDP while these companies are international now, but still, it's another metric showing the market is very expensive. Just the sheer amount of concentration in just a few companies is honestly insane, like if you actually think about it. Time and time again, throughout history, people say this is too big to fail, this time is different. I'm starting to be skeptical. Even JP Morgan is estimating a higher chance of recession. And if that's not enough, look at the insiders. Insiders are selling way more than they're buying, and those are the people that are literally as close as possible to the action. So why are they selling? On top of that, we're starting to see weakness in the labor market. Unemployment is slowly going up. We're seeing job cuts left and right. We're seeing weakness in the subprime auto loans. All this means the economy is weakening. Then there's Michael Burry, the guy who famously called the 2008 crash. He recently put large put positions on Nvidia and Palantir, and then a little bit after that, delisted his whole fund completely in an odd move. The IMF and Bank of England recently both stated that we are at risk of dangerously high and over-concentrated positions in AI stocks, which now make up a third of the entire S&P 500. But what really sealed it for me is the sentiment. On my algorithm on X or Facebook, well, maybe not Facebook, but mostly X, YouTube, Reddit, all you see, or at least all I see, is everyone buy the dip, buy the dip. It's always going to go up forever. And while I do agree, long-term good investments will go up, people older than me and younger, like 35 and younger, have never really experienced a full crash in our investing careers. On top of that, people are using more leverage than ever. And if you look at this chart, it shows that people get euphoric, they start using more leverage, and then it's followed by a crash where people are more cautious, and then it starts all over again. People get euphoric again, start taking out margin, debt to basically gamble on the economy and the market, and then it crashes again. People are more cautious, and then look where we are today. Now, this chart isn't adjusted for inflation, so it makes today look a lot worse, but still, it shows that we are using a lot of margin right now. The 2001 tech bubble crash, the 2008 financial crisis, both took the market about 5 years to recover. And then in the 70s, the Nifty 50 crashed, and it actually took 20 years to get back to where it was. Just think about that. Basically, if you're my age, you've been investing and all you've known is just going up. Small little dips, but fast recoveries, like in 2020, 2022, Liberation Day. The economy already feels shaky. Just ask anyone. I mean, at my job, way less people are coming in the stores than usual to buy new things, especially this time of year. This is our busy time of year, and we've been dead. And the government shutdown did not help either, considering that the government is the biggest spender in our economy, which runs on spending. It just feels like everyone's stretched thin, and a small shock could bring the whole thing down. Now consider this, Warren Buffett is sitting on 300 billion in cash. Do you think he's just some old fool who doesn't know what he's doing, or is he more cautious? Now, I will say he did buy Google recently, but that was just a small portion of that 300 billion in cash. So here's what I'm doing. I'm not going all in or all out. I sold my risky positions like tech and growth stocks, AI stocks, but I'm still heavily invested in the market. I just trimmed a lot of my riskier positions. I'm no longer actively buying, really. No longer passively buying either. I'm just stacking all my extra cash into a high yield savings account. Granted, I know that this thing could just keep on going for years, but eventually it is going to crash. It has to. The laws of nature demand it. And when it happens, I want to have dry powder to buy the real dip, not these little fake dips we've seen the last couple of years, but a real hard crash. To play devil's advocate, yes, this thing could be propped up and keep going for years, and I personally could miss out on some gains. But I'm more than happy to just slow down and just start building some cash positions in case. You never know. In a big crash, you could lose your job. An emergency could happen. You need to have some cash savings. And it just worries me seeing everyone my age using margin, always just going all in, expecting everything to go up consistently forever. So it's just something to think about. Because at the end of the day, markets cycle, and it's been a while since we've actually had a real correction. If you like this video, please hit like and subscribe and comment below what you're doing and what your strategy is in this wild market. Thank you, and have a good day.